90% of investors say they'll buy the dip. Almost none of them actually do it when the moment arrives. Here's the thing. When the market is genuinely crashing, when your portfolio is down 30, 40, 50%, and the news is telling you the world is ending, buying more feels insane. It feels like jumping into a burning building. And that feeling, that very specific psychological panic, is the exact reason most people walk away from crashes with less money than they started with. But there's a group of investors who do the opposite, not because they're fearless, not because they have some secret market intelligence, but because they set up a specific compounding strategy ahead of time that makes the crash work for them instead of against them. That's what this video is about. And the part most people miss isn't the investing strategy itself. It's the one thing that has to be in place before the crash arrives. Without it, every other strategy falls apart. We'll get to that. But first, you need to understand something about compounding that almost no one explains correctly. Compounding is fragile. Everyone knows the basics. Your money earns a return. Those returns earn returns. Over time, the number gets very big. Albert Einstein may or may not have called it the eighth wonder of the world. The quote's probably misattributed, but the math is real, and it's genuinely remarkable.
Here's what nobody explains, though. Compounding doesn't just grow. It can be set back, significantly. And the math behind why is something that should change how you think about market crashes forever. Say you invest $10,000. Year 1, you earn 10%. You're at $11,000. Year 2, another 10%. You're at $12,100. Compounding doing exactly what it's supposed to do. Now, year 3, the market drops 40%. You're not at $13,000 anymore. You're at $7,260. You've lost everything you gained in years 1 and 2, plus a chunk of your original investment. But here's the part that really matters. To get back to $12,100 from $7,260, you don't need a 40% gain. You need 67%, because losses always hit harder than gains help. That's called the asymmetry of losses, and it's the most important mathematical concept in personal finance that almost no financial content actually covers. This is why this sequence of your investing decisions matters as much as the returns themselves. And it's why a crash can permanently damage your compounding, not because the market doesn't recover, but because most people make the wrong move right in the middle of it.
How wrong? A Fidelity study tracked a $10,000 investment in an S&P 500 index fund from January 1980 through the end of 2022. Left completely alone, that investment grew to just over $1,082,000. But if you missed just the 5 best trading days over those 42 years, 5 days out of more than 10,000, you'd walk away with $671,000. Missed the best 50 days? $76,000. You sat through every crash, you took on all the same risk, and you made 14 times less money. So why does that matter? Because according to research from JP Morgan, 7 of the 10 best single-day returns in S&P 500 history happened during the 2008 financial crisis. The best days cluster right inside the worst crashes. If you sell to protect yourself, you almost certainly miss the very days that drive the recovery. That's the trap, and now you understand why escaping it requires preparation, not courage. So here's what you actually need to do. 3 specific things set up before the crash hits, because once it's happening, your emotions will fight you on every single one of them.
The first is the one that holds everything else together. You need a real emergency fund. And when I say real, I mean 3 to 6 full months of your actual living expenses sitting in a high-yield savings account right now, earning 4 to 5% while it waits. Not 2 weeks of expenses, not a rough estimate. Real numbers, real buffer. Here's why this is the foundation everything else depends on. During a market crash, people don't just lose portfolio value. Economic downturns bring job losses, reduced hours, unexpected medical bills. Real life gets expensive right when the market is at its lowest. And when someone doesn't have an emergency fund, they're forced to sell their investments at exactly the wrong moment, not because they want to, but because they have no other option. That's not bad luck. That's a structural problem that can be solved right now before the crisis arrives.
A high-yield savings account isn't exciting. It won't make you wealthy on its own, but it is the thing that keeps your long-term compounding completely untouched while the storm passes. Think of it as insurance for your investment strategy. The second thing is dollar cost averaging, automated so you never have to make the decision manually.
Here's how it works. Instead of trying to time the market with a lump sum, you invest a fixed amount at regular intervals, every 2 weeks, every month, whatever works for your situation, regardless of what the market is doing. When prices are high, you buy fewer shares. When prices drop, that same amount buys more shares. Over time, your average cost per share comes down naturally. During a crash, this becomes genuinely powerful. Say you're investing $200 a month into a broad index fund. In month 1, shares cost $20 each, so you get 10 shares. The market crashes. Month 2, shares drop to $10. Your $200 now buys 20 shares. Month 3, partial recovery. Shares are at $15. You get about 13 shares. After 3 months, you've invested $600 and own 43 shares at an average cost under $14 each. If the market had stayed flat at $20, you'd have bought only 30 shares. The crash literally helped you accumulate more. If you found that useful, hit subscribe. There's a lot more like this coming, and you'll want to see the full picture. But here's the key word from that whole explanation: automate. Set it up so it runs without you having to decide each month. Because when your portfolio is deep red and headlines are screaming about economic collapse, your brain is going to tell you to stop investing. That instinct is the single most expensive mistake retail investors make. By automating the process, you remove the emotion from the equation entirely. The third thing is proper diversification, and most people think they have this when they don't. Owning 10 different tech stocks is not diversification. Diversification means spreading across different asset classes, different sectors, and different geographies. A broad U.S. market index fund, some exposure to international developed markets, a small slice of emerging markets, bonds for stability, maybe a REIT allocation for real estate exposure. The exact percentages depend on your timeline and risk tolerance, but the principle is the same. No single sector or asset class should have the power to collapse everything you've built. Here's why this matters specifically for compounding. When one part of your portfolio drops, you can rebalance. Sell a bit of what held up, buy more of what dropped. Forced buy low, sell high. The opposite of what most people do instinctively. And over a full market cycle, consistent rebalancing meaningfully improves returns because your compounding keeps working across the entire portfolio, not just the corners that survived. During the 2008 crisis, financial stocks fell over 55%. During the dot-com crash, the Nasdaq lost nearly 80% of its value over 2 years. Investors who were concentrated in those sectors didn't just lose money, they lost years, sometimes decades of compounding progress. That's not a recoverable setback for most people. It's the whole game. Now, none of these 3 strategies actually work unless you solve one final problem. And this is honestly the one that determines whether people succeed or fail as long-term investors, more than any technical strategy. It's the psychology. When your portfolio is down 30% and every instinct you have is screaming at you to sell, you are experiencing something called loss aversion. Research by Daniel Kahneman and Amos Tversky demonstrated that the psychological pain of losing money is roughly twice as powerful as the pleasure of gaining the same amount. Losing $1,000 feels about twice as bad as gaining $1,000 feels good. This isn't a personality flaw, it's how human brains are wired. But it is absolutely destructive to long-term investing. The solution is not to somehow stop feeling the fear. The solution is to make your decisions before the fear arrives, when you're calm, when the numbers make sense, when your thinking is clear, and then commit to those decisions in writing. A written investment plan is one of the most underrated tools in personal finance. It doesn't have to be complicated. Write down what you own and why, how much volatility you can genuinely handle, what you'll do if the market drops 20%, what you'll do if it drops 40%, and how long you're committed to holding. When the crash hits and your portfolio is red and your gut is telling you to bail, pull out that document. You already made this decision. You already knew this was possible, and you already decided what to do.
That removes the crisis from the moment because you resolved it in advance.
Peter Lynch ran the Fidelity Magellan Fund from 1977 to 1990, averaging 29.2% annual returns, one of the greatest long-term track records in investing history. And yet, many of the people invested in that fund actually lost money over the same period. They bought in when returns were high and sold when the market dropped. The fund performed brilliantly. Their decisions didn't. Between October 2007 and March 2009, the S&P 500 fell approximately 57%. $100,000 at the peak became roughly $43,000. Brutal in every sense. But investors who kept putting in $500 a month throughout that period were buying shares at prices that would eventually recover to more than 3 times what they paid. The crash didn't damage their compounding. It accelerated it. March 2020, the S&P 500 dropped 34% in about 5 weeks, one of the fastest declines in market history. The market had fully recovered by August 2020, 5 months. People who stayed in or kept buying during the drop saw extraordinary returns over the next 2 years, not because they were brilliant, because they were prepared.
Here's the summary of everything. Crashes are not rare. Corrections happen roughly every 1 to 2 years. Bear markets every 4 to 5 years. More severe collapses about once a decade. If you invest long enough, you will live through all of them. Compounding is powerful, but it's fragile when interrupted at the wrong moment. The asymmetry of losses means being out of the market at the wrong time costs far more than most people ever calculate. The 3 things to set up right now: a real emergency fund, so you're never forced to sell at the bottom; automated dollar cost averaging, so your investing becomes a system, not a monthly decision; and true diversification, so no single sector can destroy decades of progress. And write the plan. Commit to it before the fear arrives. The investors who build real wealth through market crashes are not smarter or luckier than everyone else. They just prepared when things were calm. You're doing that right now. Subscribe if you want to keep building this the right way. There's a lot more ahead.